Okay, we're live. Hey, welcome everyone. Super excited for this panel. We have amazing panelists here representing some of the biggest, most active and most liquid DEXs in decentralized finance. We have Michael Egorov, the founder of Curve, Omakase, the lead contributor of Sushiswap, and AlphaRay, co-founder of Raydium. Welcome, everyone.
Hi.
Thanks for having
us.
Of course. Yeah, so we'll be talking about DEXs and AMMs today. And, you know, it's such an important part of DeFi. Like, without DEXs, you can't have DeFi. They are the backbone, the way that liquidity is made and provided. It's, I guess, like the oil or fuel to decentralized finance. So you guys have like really a fundamental role in this space, and being kind of the founders or lead contributors at some of the most important DEXs. I'm really interested to hear your thoughts on where decentralized exchanges are headed. But first, just to get everyone on the same page on each of your specific DEXs, I would love for you guys to, let's go around and each of you can explain what your DEX does, like the main characteristics, how it's different from other DEXs. Michael, why don't you start with Curve?
Yeah, so Curve started as a decentralized exchange for stablecoins initially. And by stablecoins, I mean coins pegged to the same asset, like US dollar or Bitcoin or Ethereum. And more recently, we expanded to swapping between coins which are volatile to each other. I guess the main characteristic here is that we go a little bit beyond the original constant product formula and experiment with bonding curves a little bit to get high efficiency.
Awesome. Omakase, want to go over Sushi?
Sure. Sushi started, I guess, its novel innovation from the start was liquidity mining incentives to offset the natural impermanent loss that comes from constant product pools. I guess how we've evolved since then is to become more horizontal in nature, having constant product, also experimenting with limit orders, and also having Bento Box, which is our, as you would call, decentralized application vault. And upcoming is Trident, which is our new implementation of, I guess, an AMM platform, if you will, that's built on top of Bento Box. So the differences between that are that you can have many different types of pools, and they can be aggregated within Bento Box, and all the underlying assets can earn additional capital efficiency through strategies. So you'll have additional yield from Bento Box strategies. You'll have the yield from liquidity provisioning, and you'll also have the yield from any liquidity mining incentives that we provide. So 3 types of yield to make a happy farmer.
Nice. AlphaRay, last but not least, on Raydium.
Hi, so Raydium is a hybrid AMM built on top of Solana. So what I mean by hybrid AMM is that basically when users deposit tokens into the AMM pools, we take those and we also use those tokens to market make on top of a central limit order book called Serum. So basically the limit orders are also placed according to the K equals XY equation. It's just that. So users will be able to have 2 places to swap, and liquidity is provided for the whole ecosystem. When users swap on Raydium, they also find that there's a best price aggregator, which would look between Serum and Raydium to see which one gives them the better price. On top of that, we also have a launchpad and NFT drop pad, where we help projects get started on launch their token, figure out their tokenomics, and really help them out with marketing at the beginning.
Awesome. Okay, so let's see if I got like all of the distinctions. So with Curve, the main characteristic was Curve really spearheaded this idea of like assets to impermanent impermanent loss, and so the focus early on was with stable coins, and now recently you've broadened that scope. Sushi choice. Oh, go ahead.
Yeah, I guess we just recently we a little bit went beyond the like asset swaps, and of course it's still early, but we try to go a little bit beyond what was known. So it's I would say we experiment with bonding curves to get higher liquidity with the same deposits than was possible before.
Nice. And so Sushiswap, the main innovation there was it tries to it has all types of assets, so not like assets, and the way that it tries to compensate traders for impermanent loss between those volatile assets is with liquidity with token incentives, right? With yield farming and providing token rewards for liquidity providers. And on top of that, there's like all these other yield strategies that liquidity providers can use. Is that right?
Yeah, that's generally correct. I think it's all about when Sushi first started, we're not the first DEX. So it's all about incentives, right? How do you attract liquidity providers, and how do you design incentives that make their liquidity sticky, especially when there's definitely tons of other, more efficient, decentralized exchanges and other protocols out there as well that are rising every day.
Yeah. And of course, like if we're talking about how Sushi started, I'd be remiss not to mention the dramatic, early days as this like fork of Uniswap and the whole vampire attack, which, was one of the most exciting things to happen in DeFi, in my opinion, at least from a journalistic point of view covering this space. That was like a whole soap opera. And yeah, it was all about incentives, right? Incentivizing users to go from Uniswap to Sushiswap, and then launching the Sushi token, which happened at a time that Uniswap didn't have a token. So yeah, and we see how well incentives work in decentralized finance in general. With Raydium, I'd say is the idea to have an AMM that also has the more like the flexibility of an order book with limit orders and more maybe sophisticated tools, and it also includes a DEX aggregator which checks where the prices are better between Raydium and Serum, the other kind of big Solana-based DEX, and it also has some tooling for NFT trading. Is that right?
Yeah, we have a project called the Drop Zone, which is an area where we help NFTs with their initial drops.
Nice. Okay. So like pretty different approaches to providing one of the main activities in finance, which is trading. I think like the main thing that DEXs are still trying to solve is impermanent loss, right? And so you're each going about it in a different way. Michael, I think Curve was really innovative at first, with the like assets, and it was able to get such good pricing for stable coins, even beating centralized exchanges on some cases. And so that's how Curve was able to just like rise really quickly in TVL and in trading volume. So now how are you managing impermanent loss by adding more volatile assets?
Right. Well, I would say we haven't been yet focused on solving impermanent loss in particular. So I would say at the moment, the volatile asset pools, they still have the same sort of impermanent loss as Sushi or Balancer would have. And there are some ideas how to do that, but they are not yet rolled out. So that's... I would say right now, the impermanent loss in particular, it's probably solved similar to how it's done in Sushi today, right? We've been focused more on efficient algorithms for like having higher liquidity while having the same deposits. But impermanent loss is a different problem, which can have very interesting solutions, but they are not yet discovered, I would say. Not yet publicly discovered.
So I'd love to hear all of you guys' opinion on this. I've seen this argument made by SBF, who is, of course, closely tied to Solana. And what he's said before is that it will be very hard for AMMs to compete with centralized exchanges and with order book exchanges because of impermanent loss. His argument is that, maybe AMMs are good for kind of the long tail of tokens, but for, large trades, for institutions, for just like professional traders, AMMs won't ever be able to compete with that level of just tight spreads and just sophistication of tooling. What are your thoughts on that? Whoever wants to go first.
I think generally the space is, it's still early days in DeFi, right? The infrastructure, I would say, it's still nascent. We're only starting to see L2 scaling solutions like Arbitrum and Optimism, and even ZK scaling solutions come out. I think on the level of, so order books don't deal great with volatility, especially if assets are incredibly volatile and there might not be enough, I guess the spread might be too wide, right? So I think there may exist particularly a future where both are combined, right? Where you could have decentralized systems that have AMM functionalities, and also they have order book limit order style functionalities. And it's a matter of UI, right? Serving the best price to the user. If they can fill an existing limit order, then they would essentially have like a zero fee, no price impact trade. So I think the space is definitely moving towards optimization. We can also see in concentrated liquidity pools on UniV3, they have the opportunity for people to launch 10 basis point fee pools, which is already competitive against Coinbase. FTX has dropped their, I guess, fee down to 7 basis points. So I guess in Sushi's regard, right, when we come out with Trident, there's a couple methodologies. So we allow for completely configurable pools. If people want to set the 7.5 or 7.5 basis point pool, they can. And then immediately that liquidity would be very competitive against centralized exchanges. Then comes into the considerations of like gas fees and like UX and like UI. And I think those will be gradually solved through like Arbitrum and like scaling solutions, right? And then at the end of the day, right, Sushi, to address the question, I guess, of impermanent loss, right? As Michael said, there's no public solution for impermanent loss. This is kind of native to AMM designs. But there are ways to kind of offset it or band-aid it to a certain degree, right? This is why we put our AMM into Bento Box. So the underlying like balances can earn yield. The more yield you earn, the more technically you're offsetting your impermanent loss. And also, as I said before, right, there is the opportunity for more blended style AMMs that have limit orders, that have kind of very highly decentralized order books, and also there's also the room for constant product pools, etc., to all work together to essentially find and route the best price to the user. And I think those two things will be interesting developments. And there's already a lot of use cases where I would say, lots of decentralized infrastructures becoming super competitive against centralized exchanges. To give a brief example, we've experimented with limit orders on Bento Box on Polygon. And these limit orders are interesting because since Bento Box uses the concept of virtualized balances, you can open as many limit orders as you want, as long as you have the balances to fulfill them. And all of those limit orders that you open are constantly accruing yield and interest from Bento Box strategies on Polygon. This doesn't happen on a centralized exchange, and centralized exchanges kind of like limit you to the number of limit orders you can open based off of your balance, right? So we're starting to see like very interesting UX UI like changes that kind of decentralized infrastructure affords. But as I said, it's still early days, right? Ethereum mainnet, etc. There's lots of infrastructural improvements, UX UI. The whole like wallet, onboarding process is still a huge pain point for average users. But these things will eventually get solved. And then, protocols like, Raydium, Sushi, Curve will be, start to become very, very competitive in specific use cases against, centralized exchanges.
So super interesting. So this view of hybrid DEXs that combine AMMs and order books and take advantage of the new technology on layer 2s that can compete in functionality even with centralized exchanges. Yeah, I mean, if that happens and you're able to just match users' needs like so specifically, even in a decentralized way, I think AMMs start to become competitive with centralized exchanges. Michael and AlphaRay, what do you think?
Yeah, so I think this Sushi point of view was a little bit more like an engineering one. Like how can we use all existing Lego pieces which we have to be able to compete with centralized exchanges? And yes, maybe even with that it's possible. But I think we are able to do that even on a more fundamental level. If you look at liquidity efficiency of probably best market makers out there, it appears that it's probably not that difficult to match their efficiency in the world of bonding curves. Not really with constant product invariant, because that one is not that capital efficient. But I think if the capital efficiency is larger only by factor of 4, we already can be as efficient as commercial market makers. And really, I don't think we are competing with centralized exchanges by themselves. Centralized exchanges, they are kind of designed to do it so that we have one side, the seller and the buyer, right? And then it matches them, right? But most of liquidity on centralized exchanges is not coming from those sellers with limit orders. It's actually coming from commercial market makers, and commercial market makers are not really that efficient. So it looks like it's possible to probably match their efficiency while probably ending up with more money after this long market making process than they would give to the customer who engages with them. So I think we are at least DeFi automatic market makers with some novel bonding curves, they are definitely able to compete with centralized exchanges combined with market making firms. As for limit orders, I also think that there are a few things possible over there. And Uniswap 3 is a great example of the first step towards what's possible to do with limit orders. Like, where if you replace a discrete limit order with something continuous in a range, that's already something, right? And it's possible to do even more interesting stuff with limit orders to even take over that niche. And really, I think that order books is an antiquated concept which originated really from paper order books, right? They were just digitized. But I think in this digital world, not necessarily on blockchains, it is really possible to switch to more continuous models, whether continuous in price space or continuous in time, and it's possible to do something interesting. But it's when we are talking about replacing market making firms, it's really like the automated market makers. But when we are talking about replacing limit orders, it's already like a little bit in between automated market makers and limit orders, right? And these concepts, they don't have to exist in decentralized world. They could exist on centralized exchanges as well. It's just centralized exchanges, they really tried to follow the classic order book models, and I think they definitely could go beyond that. So
interesting.
Yeah, but I haven't seen that though. And I'm totally all for like the decentralized Web3 world taking over centralized exchange world.
Do you think you should replace market makers, or are decentralized exchanges really trying to attract market makers?
Well, I mean, market makers on decentralized exchanges, they don't have to be that's as sophisticated as on centralized exchanges. They don't have to run any bots because the smart contracts run bots for them essentially, and you can attract not as smart of a liquidity. So you don't have to have this middleman who runs the bot. You can pretty much remove that middleman. And because they collected, I guess, quite good revenues, they also probably attracted only like part of audience and didn't attract the broader one. Who didn't want to pay these fees. Well, hidden fees. So now they can go directly to DEXs, and I think that DEXs are able to attract more liquidity. Well, even institutional one, but as soon as institutions get comfortable with Web3 world.
Yeah, it's a matter of when, not if. So you all have mentioned concentrated liquidity, and I think that's been one of the big innovations in decentralized exchanges, at least recently. How are you incorporating this new concept? And how has it been working so far? I mean, do you think these like concentrated liquidity pools and these like specific bonding curves rather than the initial generalized bonding curve, do you think that transition is here to stay? Like, is this kind of the new model for DEXs, or are there cases where just like a simple generalized bonding curve still works?
Well, simple generalized bonding curve is a good backoff, which is also a good benchmark. But I think specialized ones are possible.
Definitely. I mean, I think it's if you look at all the liquidity providers in DeFi right now, it's about preference, right? There's definitely a specific group that has a specific preference for concentrated liquidity. It's, you know, highly capital efficient if you're like sophisticated enough. So those models will always be options that are, I guess, here to stay, right? Because concentrated liquidity definitely has its benefits. And, you know, as Michael said, you know, constant product is always a good automated, you know, fallback, right? It's the easiest one to understand. Most liquidity providers and also institutionals are beginning to, you know, understand constant product. Concentrated liquidity probably requires like a bit higher level of sophistication. And I think at the end of the day, like going to the topic of like market makers, if you look at DeFi, the entry level into DeFi, especially for these like long tail assets, is very, very low. Like traditionally, if you wanted to, you know, even list anything on an exchange like Binance, etc., you have to engage with market makers. You have to provide, you know, a certain amount of liquidity, probably even pay listing fees. So that whole world is more sophisticated and has like a higher barrier to entry. Whereas if you see in DeFi with like constant product, right, it's much more lower barriers, right?
And that world which you mentioned is definitely the one which the DeFi is disrupting.
Definitely, definitely.
Yeah, I think that's exactly what was so exciting about AMMs to start with. Just like the low barrier to entry for both, you know, projects looking to list their tokens. Now suddenly anyone could have their token be traded without paying huge fees or dealing with anyone. And also for liquidity providers, like suddenly there's this whole new way of earning you know, yield in crypto, which is, you know, it's not like about speculative trading anymore as much as, you know, you can go and provide liquidity and get fees. It just like opened this whole new world in crypto. So yeah, I agree. But I mean, does concentrated liquidity have to? I mean, isn't it still possible to just have that low barrier to entry for listing tokens and providing liquidity, even with concentrated liquidity, or does that make things harder?
Yeah, well, there are, if everything is fully automated, you may have parameters which suit all assets are a little bit hard. So, but still. We still look if that's possible. I think it is. But yeah, I think it's possible. I think the bigger problem right now is gas fee on Ethereum, which layer 2 solve and whatever. But that's kind of a different problem.
Yeah, so let's talk about that, because I think that is kind of an elephant in the room when talking about any application or protocol building in DeFi. And yeah, that's what we have, you know, chains like Solana really taking off, and projects like Raydium building there. Just they're really high gas costs. So how are all of you dealing with that? Like, are you? I know Sushi is on many different chains, and I'd imagine you're all looking very closely at different scaling solutions. So yeah, what's your take?
I guess as Sushi, right, we're pretty much chain agnostic, as we like to think of ourselves. Anywhere that's EVM compatible, we'll probably deploy to, or it's on our like kind of deployment timeline. So I think so far we've deployed to roughly 24 testnets and, you know, mainnet.
Wow.
So, you know, each to be honest, I think from a technical perspective, right, like optimistic, you know, rollups are the next innovation, and then after that would be, you know, zk snarks and, you know, zk proofs and zk sync and, you know, all of those zk scaling solutions. For now, I think the L2 scaling solutions are pretty nascent. We have a lot of nascent, you know, EVM compatible sidechains, if you will, and these all foster their own communities. So Sushi's approach is, you know, we're waiting for kind of the L2 scaling solutions to mature, and we're working like, you know, very closely with Arbitrum and other teams. And for, you know, these side chains, they're great opportunities to create and foster more communities. I think Michael. Yes.
Yeah, we follow pretty much similar approach. So we do deploy on different side chains at different layer 2s. But actually, I will have to disconnect pretty much right now.
Oh, okay.
So, yeah.
Well, Michael, thank you so much for joining us. And yeah, go ahead and yeah, thanks again. It's great getting your take so far. Bye. And AlphaRay, like, are you only building on Solana? Like, what do you think? Like is it gonna be like a multi-chain DeFi future, or do you see kind of Solana winning out?
We definitely see a multi-chain future in the short to middle term, at least. Who the final winner will be very hard to call at this moment. Being on Solana, since everything is written in Rust rather than Solidity, we're not very EVM compatible at the moment. But we are looking into it, and it is exciting to see the cross-chain world.
So are you looking to launch on other chains?
Not at the moment. We're just, well, we always need to keep up with the ecosystem, right? You gotta see what everyone's building on other chains, what advantages there are on other chains, and just understand the space better. Even if you can't really do anything on other chains at the moment, Solana is a little bit siloed off in that it doesn't have many bridges applications to other chains either. So it's important to just keep looking around and make sure that you're up to date on everything.
Yeah, I think we're starting to see this this evolution in DeFi where you have kind of EVM compatible chains and then non-EVM compatible chains. Whether, you know, it's already bringing more diversity to the space, whereas before it was like Ethereum and non-Ethereum. Now you have like different options. As long as they're the chain is EVM compatible, then it's like really easy for projects to just launch on multiple chains. I think that's a really interesting development. But with, you know, all of these different layer 2s on Ethereum and side chains and other layer 1s and projects launching everywhere, how do you deal with liquidity fragmentation? Like if there's a Sushiswap, like on, like you said, like 24 different test nets, and then that goes live, how do you deal with just like the user experience of having users on liquidity across so many different chains? Like how mature is the bridge infrastructure to port that liquidity over? How is that looking?
Yeah, definitely. I think essentially when Sushi moves to a new EVM compatible chain, it's kind of like a restart, right? We're relaunching. We have to seed it with new incentives. We have to attract new liquidity. I think bridging is definitely an important topic these days. Lots of the chains we've interacted with, they either have their own native bridges and their own solutions, but we also see like third-party bridges, right, that are becoming very prevalent in this space. And I think generally liquidity fragmentation is a concern, but as I said, most of these sidechains that we go to, we discover that they have entirely new communities and new liquidity. So we don't really see any liquidity fragmentation from our mainnet liquidity or any, like, you know, people moving significant amounts, right, to other networks that might have, you know, temporarily, you know, higher incentives, etc. I would say liquidity is pretty sticky to the chain. And we do see some movement to Arbitrum. Like Sushi has around 350 million TVL there currently, and that's all organic with very low incentives. So there is some confluence of some networks. Generally, with regards to liquidity fragmentation, I think it's going to get quite interesting when we put our AMM onto BentoBox, because BentoBox has this concept of, as I said, virtualized balances. So when you deposit your tokens into BentoBox, you're technically getting a share, and you're getting like a virtualized balance that's represented through every decentralized application on within BentoBox. If you take that into consideration, so all those 24 networks that we kind of deploy the minimum bare bones AMM to, we've also deployed BentoBox. There are solutions to have all the bento boxes interact with each other in kind of this reserve banking, fractional reserve banking style, where users can be on specific chains and gain access to the liquidity of other chains without even realizing they're leaving their, without even having to leave their chain or switch to another network, or even realizing that that liquidity is actually being sourced from another chain. I think there's some opportunities in, meta transactions and other unreleased, I'm dropping a lot of alpha right now, but, unreleased, solutions that will allow kind of this, this cross-chain use of liquidity.
That's
that'll
so
be super interesting. And, there's also other, we're working with other partners on ZK scaling solutions, et cetera, and brainstorming ideas where, we can use the liquidity on mainnet without actually having to, fragment it. So there's lots of discussions about these. I think, definitely in 2 to 3 quarters, we'll start to see this multi-chain infrastructure make more sense. Because currently it doesn't really, right? Because it's just like technically a bunch of new sushis on new chains, none of them really related to each other other than the brand, essentially. And we'll start to see lots of different architectures emerge, and that should be definitely interesting.
Wow, that's so interesting. I mean, a few points to note there. One is, I think it's notable what you say that on each chain you launch, you find a different community, different users, and different liquidity. So it's not like launching on other chain means that you're taking liquidity from one chain and porting it to another because of incentives. It's like, okay, if there's someone who is trading on Ethereum, they will stay on Ethereum, right? Even if there's like incentives elsewhere. If there's traders on Solana, they will stay there, and so on. So that's a really interesting insight. And then the other point of having, maybe viewing like layer ones as the place where as like the the backbone, like where liquidity is sourced, maybe from liquidity providers and market makers or like institutions, and then if there's a way where you can cross over that liquidity or unite it somehow, and then users on each different ecosystem can just stay in that ecosystem, but then they can benefit from having just like this shared, like this huge shared pool of liquidity across many different layer ones. Is that kind of your vision on where this is going?
Yeah, this is at Sushi, right? We've always described kind of BentoBox as a layer 1.5, if you will. And this 1.5 has various advantages, right? Where different bento boxes can technically be associated with each other, given appropriate upgrades. But so that's the general vision, right? We're moving to, and this is why we're so aggressively expanding to every possible EVM compatible chain, because at the end of the day, we want the users, we want to kind of at least insert ourselves into those communities and let them know that, hey, we're a solution. And then eventually it's like a pinwheel effect, right? You start building up unique types of liquidity on other networks. And then eventually the solution would be to unite all of the liquidity together so that all your users have a net benefit of being able to access all the disparate, like specialized liquidity from other networks, right? For example, it may be the case that Sushi on Phantom has a very deep, ETH Phantom pool, right? And has the, even with constant product, it has like low price impact on that pool. That might not be the case for mainnet because there's very little Phantom liquidity, as an example. And there may be a future in Sushi where it doesn't matter where the liquidity is, as long as it's on kind of Sushi, regardless of the network, the user will be able to access and perform those swaps and realize those, realize that liquidity, regardless of what network you're on.
I mean, that makes a lot of sense. That would be pretty ideal. And you mentioned that you're doing this on EVM compatible chains. So so you're what does like so like are you on Solana? Like, do you plan to be there? And then
I think I think a lot of chains will support EVM compatibility. It is kind of an older standard. For us, it's more, to be quite truthful, it's a resourcing issue, right? We don't want to be maintaining separate stacks and separate code bases and separate auditing processes to kind of keep them all in line. We are thinking and working on experimental kind of like ZK scaling solutions, but that's all. Those are all experimental. Whether or not they go into production, or whether or not we even those solutions might even be EVM compatible one day as well. And to be honest, I think there are some projects on Solana that are trying to make Solana EVM compatible as well. And when that happens, Sushi will definitely go where, as we said, we're chain agnostic. We go wherever EVM compatibility is.
Got it. AlphaRay, so how do you, as a project on Solana, how do you deal with this kind of framework where there's like a lot of liquidity just on EVM compatible chains? Do you have like bridges that you can use to get to those users and to that liquidity, or what are kind of the plans there?
Yes, so we're looking at, so Solana is actually a very interesting place to be right now in terms of liquidity fragmentation, because it doesn't have a official an official bridge. So then what happened is that there's a lot of solutions coming out. Everybody's making their own bridges and trying to be the biggest bridge on Solana. But what happens is that every bridge comes out with their own version of a bridge token, right? So you have this bridge's wrap token from Ethereum, and that bridge's wrap token from Ethereum. These are both wrapped Ethereum, but they are actually different assets because they're from different bridges. And what we see is liquidity really, or a problem we perceive is liquidity getting scattered between these competing bridges. And users coming in from one bridge would not be able to access liquidity or trade against liquidity that came from another bridge. And this is already starting to cause a small headache here. But,
oh, wow.
Yeah, so we're working hard on figuring out ways to make this, make everybody more compatible.
Oh, I didn't realize that was happening. Okay, so if I understood correctly, it's people are coming on Solana through all these different bridges, but when they do so, their tokens become wrapped on kind of whatever bridge they used, and so those wrapped tokens can't interact with each other. Is that what's happening?
Yeah, so it's kind of like you can think of it like Ren BTC versus Wrap BTC on top of Ethereum, and just adding 4 more different bridges to that solution group.
I mean, it's bad Michael left. He would have a solution.
Yeah, because Michael would be perfect for this.
Right. Yeah.
Why? What's Curve doing?
No, because
Curve has multiples. Yeah.
they're like assets. So they're like pegged assets, you know, REM BTC, wrapped BTC, they're all pegged technically to BTC. So that's like a perfect, you know,
Oh, that's a perfect
market
use
for
case. Yeah.
use case for Curve. If, you know, they're willing to build on Solana and, you know, re-architecture into Rust. But yeah, they, you know, those are good solutions.
Oh, that's right. There can be a DEX that's focused exclusively on trading all these bridge assets, basically.
Yep. Yeah, these different bridging standards.
Ah.
This is also, I mean, this is commonly also becoming a problem on multi-chains in general, right? There's different bridges that are coming out. All of them want to be the EVM bridge, and some of them have their own standards, and some of them have the native assets. So on some of the newer multi-chain networks that, newer, you know, side chains, or, you know, even on like Kusama style Polkadot chains, right? We're starting to see this issue that Alpha just described, right? Which is you start to have micro liquidity fragmentation because the assets are not the same, right? You could have different standards of WETH, right? You could have different implementations of bridged sushi, for example, and you know, Curve would be, you know, and Curve and also stable swap solutions would be, you know, perfect solutions to address this issue.
That sounds like, yeah, that sounds like a headache. Okay, to start wrapping up, I don't want to go before talking about yield farming and liquidity mining. It's such a huge topic. You know, it kind of fueled DeFi summer, and DEXs are of course like a key piece in all of this. So, you know, to catch everyone up, of course, liquidity mining is the practice of giving users and liquidity providers on protocols token rewards in exchange for using a protocol. And now there's this, I don't know if backlash, but at least like there are different projects trying to look for alternatives to yield farming, because one of the consequences is that of using yield farming is that, you know, liquidity comes and goes very easily. You know, as soon as rewards are over, all of that liquidity goes away to the next farm. And so there's projects like Olympus DAO and Tokamak trying to kind of reformulate how people can attract liquidity. So yeah, I'd love your thoughts on this development. Like how do DEXs, which have been such a big part of yield farming, how do they fit in this kind of new movement?
Definitely, I think for yield farming and its, you know, long-term sustainability, it's I think yield farming was essentially a bootstrapping mechanism, right? Because you want to attract liquidity quickly, and then you want the liquidity to stick once volume picks up, once fees pick up, etc. Because then those you know, liquidity positions can become capital efficient. You know, as Michael mentioned, Sushi, we take a very engineering oriented approach to this, which is you know, liquidity mining rewards won't last forever. So it's really about like using existing Lego pieces to continue yield mechanisms. So this is why we're building on top of BentoBox, and why BentoBox has kind of these virtualized balances that you can use the underlying balance and make them more capital efficient through like different strategies. And you know, this should make up for you know decreasing incentives, etc. There's also, you know, lots of discussions regarding, you know, concentrated liquidity, because if you know how to use concentrated correctly, right, you stand to gain outsized fees, right, which should be more than any like incentives that are offered to regular, you know, equalized kind of constant product pools. I think that is, you know, we'll continue to see different incentive structures pop up. So we're already kind of seeing it, and you know, people are talking about like DeFi 2.0 etc., like these kinds of new styles of incentive programs that are developed. Those can definitely also be incorporated in DeFi 1.0. But generally, I think it's all about, the incentives give you a runway, essentially. But that runway eventually ends. And the expectation at the end of that runway is that, you've built a system that's highly capital efficient and can stand on its own without incentives. So that's where I think generally the whole DeFi space is moving, right? As people are like tamping down rewards, etc. And as protocols are becoming more and more efficient, or engineering new ways to become, to combine efficiencies in a sense.
So you don't, I mean, do you see liquidity mining, how it's been used so far? Do you see that still continuing with kind of this, maybe in a combination of these new mechanisms?
Yeah, I think so. I mean, we definitely see that. We're also seeing like, for example, on Polygon, we see like different liquidity mining types, right? We see a lot of like auto compounding vaults, etc. We'll always see kind of these like, I would say, smaller DEXs with like hyper incentive programs. But whether or not they can maintain those incentive programs, I think will be short-lived unless they kind of prove that they can like generate, actual volume. I think that's a combination of both arbitrage and also, retail and institutional trading. And at the end of the day, I think these will become more and more efficient, right? Even on Arbitrum, for example, or when we first went to Polygon, on kind of these like high latency networks, usually we would see around 20% utilization of the liquidity from constant product pools. And on those networks, we were seeing on some days upwards to, 80 to 100% utilization of all the liquidity, right? I think this is what happens when people are like performing, when trade sizes are smaller, and there's lower gas fees or almost no gas fees, and people can, and it accommodates more users, and so you see a higher volume of trades.
Wow.
So, right, I think, as Michael said, right, it's all about like the fundamental design of AMMs. As those improve along with the L2 scaling solutions, it might be the case that, liquidity mining is technically not necessary unless you're first starting, right? But in order to start, you'll need to kind of like defend your moat, right, for the long run. And I think the moat really comes down to both community, right? It also comes down to, branding. It also comes down to, the pace of innovation in kind of the decentralized autonomous organization. These things are all moats. And this is what has kept Sushi pretty resilient to other, as you would say, food tokens. And yeah, right.
Yep. It's so interesting. It is kind of, yeah, like viewing liquidity mining as almost like a marketing, like budget at the start of a project, and then if the project is strong enough, then it won't even need liquidity mining in the long run, and yeah, like implement that program at the start as these projects create their own mode or their own way to differentiate themselves among so many competitors, which has always been, I think, such an interesting challenge for DeFi and just like open source building in general. Create a mode in a world where everyone can just come and fork your code.
Definitely. I think what can't be forked is, community and, human resources and human talent, right? Those things are very difficult to acquire, like organically. And, gratefully, Sushi has been able to establish that moat, right? We have a very large community. We also have, lots of contributors. We also have very talented contributors. And this has given us at least an engineering product edge, right? Where we're building new features all the time.
Yeah, I think that's been kind of a theme all throughout DeFi. that you can't fork community, and it's becoming kind of like a cliche. And I think there is kind of this debate on whether the tech wins or the community wins. Of course, like if you have better tech, that is a huge advantage, but it's still really hard to beat out a strong community, even for if a project doesn't have like the most innovative design, or just like even if a project that doesn't have the best tech, if they have a better community, I think that's already, it's really hard to overcome.
Exactly. And at the end of the day, all of it is kind of about product market fit, right? And I think many protocols are still discovering, what elements or what dimensions they can meet product market fit.
Yeah. Alpha, what are your thoughts here on like the future of liquidity mining and yield farming and modes in DeFi and Web3?
Yeah, so basically, I agree with a lot of what Omakase said. What I'd like to add on to it is, well, yeah, so yield farming cannot last forever, right? Infinite tokens don't really work out that well in the end. And basically, we think of the problem as you have users who need to swap and they need liquidity. You have liquidity providers, or these people would generally be investors who are looking for an AMM or an algorithm, something to invest in for more steady yields. And you also have projects that need liquidity for their projects. So what we've done is we've started the fusion pools, which is a way for projects to generate their own liquidity. Basically, they give out rewards to their own project tokens, and they build liquidity in this way. And for them, in the end, it's about, well, there's some sort of an impermanent loss. Back to the impermanent loss question earlier, there would be some permanent loss in this, but if you look at any major market maker or if you look at any market maker on centralized exchanges, they would also face impermanent losses. That impermanent loss isn't just a problem for AMMs, right? If you're market making on a centralized exchange and you have a set number of tokens, when the price goes up and you are selling these tokens, that is very much still a permanent loss. It's just about making a AMM or a smarter algorithm that you can capitalize more when the prices are less volatile, or lose less when the prices are more volatile, right?
Mm-hmm.
So it comes down to solve the problem of liquidity incentives. It's basically, how do you appease the investors? Basically, how can you generate yield for them when there's no more liquidity mining rewards? So this could come down to smarter market making algorithms. So improvements on the standard AMM curve, or higher capital efficiency, as Omakase said, through lending or through other methods of generating yield for the investors. And for then users, it really comes down to attracting end users, right? Because all this is generated, all these yields are generated from end users actually trading and using the protocol. And
Right.
yeah, so it is a combination of these three. How to do appease the investors and the users while also attracting projects at the same time.
Yeah, super interesting. I think, in general, in DeFi, you're combining so many different sophisticated and complicated things with crypto and finance. But in the end, when it really comes down to it, it's about, providing useful tools for users. Like you can add, crazy yield schemes on top, and strategies and all these different things. But if you don't have a good product, and if you're not solving a problem for users, then it doesn't matter about in the end. Like all of those fancy yield strategies will fall and run out at some point. Yeah, so we're coming to the end of the stream. Really thank you guys for taking the time. This was such an interesting conversation. So much alpha leaked. And yeah, it's really interesting how DEXs are shaping up. Like I'm compared to where they were in like 2019 when DeFi started, and how far the space has come in just a couple of years is mind blowing. So I mean, I have no doubt DEXs will take over finance and trading, because look how far we've come already. So thank you guys for joining me. Have a great rest of your day, and thanks everyone who joined the stream. And claim your POAPs. One second. It looks like the link isn't showing for the POAPs. I will try to drop the link. Sorry about that. Okay. Dropping the link. Sorry about that. All right. There we go. I think that worked. Anyways, thank you so much, Alpha and Omakase. It was a pleasure chatting, and thanks everyone. Bye, guys.
Thank you.
Bye.
Bye-bye.